Investments in securities are subject to market risks. Read all related documents carefully before investing. Hello and welcome to the Weekend Investing Daily Bytes episode on 29th of May. The markets opened with a huge gap up, almost 150 points. The US lawmakers have agreed for raising the debt ceiling. We will talk more about this in this episode later. But the basic idea is that the government will be able to borrow more money and spend more money, even though they will be doing a lot of deficit spending. But the the lawmakers have agreed, both sides of the politicians, the Democrats and the Republicans, they have agreed on pumping more money into uh, the government coffers. So they will be borrowing more. The interest rates are already, coming to a point where the interest cost itself is biting. The interest itself will become equivalent to their defense budget at this pace by the end of the year. So while it is a process of kicking the can down the road right now, it really does not solve anything. There are some short term as well as medium term ramifications of this. We will discuss about it. So, but the immediate uh, market perception of this event was that it's a relief that they have agreed that there will be no US default. Otherwise, there would have been very severe financial crisis all over the world. It has never happened before, and hence it was also expected that before the 11th hour, both parties will agree on some compromise, and this story will be left for solving on another day, some other day, some other year. So Nifty also going up in sync on this relief rally globally. The US markets are closed for Monday for national holiday, and we will know by Tuesday evening Indian time how the real reaction is to this. The US futures are not showing any sign of any movement right now. So Nifty gapped up, stayed up for most of the day. I think also because we are now nearing the previous all-time highs, so the moves here will be a bit jittery as people become nervous near all-time highs. But the fact is that we are moving towards all-time highs. Very, very strong uh, thesis that the market is presenting to you. Banks led the move with State Bank up 1.5%, HDFC Bank, Kotak Bank, IndusInd Bank, Axis Bank all up. ICICI did not participate today. ONGC was down based on its results, minus 3%. Reliance moved up a bit. ITC has been going very hard at 450 plus 1.1% up. Mahindra doing very well today, the best amongst all auto stocks and Nifty stocks as well, plus 3.4%. Titan up 2.25%. Steel and cement stocks doing quite well. So overall, there was a very good relief, and it seems like the next leg of the market is setting up. We can see here in the sectoral overview, metals taking the lead at 0.9%, real estate, commodities, consumption stocks, bank nifty, autos, PSU banks, all doing quite well. Only IT stocks were the one which were down 0.4%, which is also sort of, despite Nasdaq doing quite well in the last few days, is a bit telling that US worries are not over. So IT still remains a dependency on the US market is huge, and IT was the one which took the brunt today. Mid cap stocks, mid cap index already made a new high on the previous session. Today, further high 33551. So this move now is almost 4,000 points, 15% move roughly already here 13 to 15%. So it's a good move. At some point, it'll start to have some correction. But right now, new breakout, new highs, all looking good. Small caps also moving up gradually, still not anywhere near all-time highs, about 5 to 7% away, but a good move nevertheless on this. Bank Nifty hit a new all-time high today. Extremely good chart point of view that any index hits a new high. But the intraday move today was not so confident, where we went much higher but gave up some ground. But that's okay. I mean, intraday move is fine as long as the daily moves are strong and remain near all-time highs. That is doing all right. So coming back to the U.S. debt ceiling, we will try to simplify this. As per my understanding, I don't claim to be any economist or have a very deep understanding of this, but whatever I do understand, I would like to share with you. You can tell me in the comments whether my understanding is right or wrong, or if you would like to add something to this. It by discussing all these, some we do get to some learnings and some outcomes and decisions on this. So this is slightly old chart, couple of years, I think 21, 22 it, are not included in this chart, but nevertheless it gives you that picture that this black line, which is the US GDP, which was nearly 20 trillion just before around COVID time. This has sort of stagnated in the past many quarters, and the red bars are the total debt in the system there. Now, since 2008, since the GFC, you can see that the trajectory of the debt has gone up dramatically. So in 2008, the total debt was under $10 trillion, and now in 2023 it is above $30 trillion. And just in the last 2 years, it has gone from sorry, not 2 years, from 2018 uh, till now, which is 30. So $10 trillion have been borrowed by the US government in the last four odd years. And this the debt ceiling that has been raised. So what is the debt ceiling? Debt ceiling is basically a imaginary credit limit, you can say. So let's take an example like this, that you are an individual, you make let's say 19.5 lakh rupees a year as income. You have a credit card debt of 27 or 30 lakhs. Your annual income of 19 and a half lakhs is not sufficient for your expenditure. So you have a lot of expenditure, which your current income, which is this blue line, which has been a flat line as a percentage, has not changed. So you are actually losing about 2 lakh rupees, about 10% of your revenue per year. And that 10% revenue loss that is happening to you every income loss that is happening to you every year is adding to your credit card debt. So now your credit card debt is 30 lakhs. You are earning 20 lakhs, but you're not able to save anything out of it. You are losing 2 lakhs a year on that. So you are losing 2 lakhs and your credit card has maxed at 30 lakhs. Now what will you do? So you are this debt ceiling is like you begged your the powers who control your credit card limit, that please allow me some more time and please allow me some more borrowing. So that 30 lakhs has been set at 34 lakhs for the next 19 months, that you can go from 30 lakhs to 34 lakhs, and we will deal with your income problem at some other time, because right now there seems to be no solution to it. So what has happened? You are continuously making losses every year. You are not able to meet your budget. You are whatever income you have is not going up because you are not upskilling yourself. Your job has stagnated. And in the context of the US budget, this is what is happening. So their deficits are going up. You can see this red line, which is the spending, and the blue line is the revenues. So revenue is not going up, but spending is going up and also spiking in during COVID times, etc. So you are having to make special provisions, and essentially you are in a perpetual trap, because now how will you get out of this situation? You have a 34 lakh credit card limit, and probably in next 15 months you will max that also. So you will have 34 lakhs of debt. The biggest flip side, or not flip side, but the additional problem that is arising is that interest rates are rising. So earlier on that 30 lakh of credit card debt, you were paying 1% every year, and still getting away with it. Now that 1% has become 5%. So 30 lakhs itself requires you to have almost 6 lakhs of interest payment on it every year. You are already losing 2 lakhs per year. Now you are losing 6 lakhs overall in interest also. So it is just going to explode. It is going to go exponential. You will not be able to manage it within just next few years. So this is a huge problem, which is still being kicked down the road. Just like any person who is stuck in debt, the U.S. government is stuck in debt, and the only advantage that they have is that they have the ability to print money, and give that money to foreigners who are willing to take that money and give them services and goods instead of that money. So that sentiment or that acceptance is now gradually coming down. US treasuries are being accumulated less by foreigners. So there will come a situation where no other country may say that, okay, I don't want US treasuries, I don't want US dollars. But it's a very difficult situation because everybody is trading in that currency, and everybody holds that. So this is essentially going to lead to persistent inflation, perhaps, because you are just not able to grow naturally, but you're having to stimulate everything. So when you stimulate, it is artificial growth. You're having to pump up things, and what we've seen during COVID will probably continue to happen. So emerging markets will get impacted to some extent here. We'll just not go into the details of this federal revenues and federal spending, but this is what is happening. The credit limit keeps getting enhanced, and regardless of which government comes into power, they keep borrowing and just hitting the max limit of their credit card. So it's like a credit card junkie government, where you just keep borrowing, keep borrowing until you are not allowed to borrow anymore. Then you fight amongst yourself, and then you raise the limit again, because foreigners are stupid enough to keep taking your paper. So the point is that immediately what will happen is probably, because there's a relief that the world is not coming apart tomorrow, markets may go up, as we have seen today. But I think very very shortly, this new ability for the US government to borrow money will get implemented, and $4 trillion will be borrowed in the next 19 months roughly. So all this borrowing will now come into the market in the next month or two. It will start to come in the market, and that will suck up some of the liquidity. So from that perspective, there will be hardening of yield, and interest rates may rise in the US, as well as other markets will follow, like always. So it may become a difficult situation in very short term. So this is not really like a takeoff that is there for next year and a half. I think very very shortly there will be issues that will crop up again, because there is no solution to the current problems of the deficit, or the interest rates, or the high yield causing institutions to collapse, or even the inflation remaining very very sticky. So all this macro and external environment is extremely, I would think, detrimental for a smooth rally ahead. But India seems to be in its own mood. India is at all-time highs, and the current flow is working well. But all this is, these clouds are there on the horizon. So anytime, the spoil sport, elements can come through. But so far, we are doing all right. I think there's nothing need to panic. As long as you are allocated properly, you need to keep taking these risks. And if we see the insights out of these, debt ceiling and the US situation, so what we have seen, we'll summarize this. So since GFC, America's national debt has been growing at a faster rate than GDP. So that itself is a problem. Now, cost of servicing has also started to go up since last year. So a credit card junkie who is now used to maxing his credit card debt now also has the additional burden of, increasing interest rate. So, I mean, the default is just being delayed. So suspending the default, this debt ceiling is just like expanding the credit card ceiling, is just a short-term delaying the inevitable solution. Debt will continue to mount until it becomes unsustainable, or the economy crashes, or some war machinery will take over. US has always, resorted to wars whenever their economy is not working well, because it's a pro-war economy where, their defense industry really does well when there is war happening somewhere. So that war situation can come over and take over things, or the only way to come out of this is either you have high growth. War, although it's a very archaic thing to talk about today, but war creates opportunity for high growth. When you go out and destruct everything, then for the next 20 years things will be building up and things will grow very fast. So that's what war does. It sort of purges out the current system, and it allows new green shoots to happen. The other way is that you allow high inflation to run, so that your current debt will keep getting lesser and lesser in value terms, as the inflation runs high. So there are only two real methods of getting out of this: high growth or high inflation. High growth will not come without war, and high inflation, can, maybe that is the whole plan, that they will allow high inflation to run, although they keep saying that inflation will come down. So market may do well right now because of this relief, but long term, medium term, I think pain remains. So don't look at it as, go all out into equities. Good asset allocation will help. I strongly recommend that you hedge your portfolio well. I'll leave you with this last chart, which is technical chart, which has nothing much to do with what I've talked about. But technically, on a chartish formation, this is what happened when you had a formation like this post a high inflation environment in 1983, and we just took off there. And some people are contemplating that, maybe the takeoff period is here and it will just surprise everybody. So with all the, $4 trillions of dollars now coming through in the next 19 months, who knows, how that money will circulate and come back into the market, what kind of stimulus will be given, so on and so forth. So just stick to your strategy. The strategy should be to buy what goes up, sell what goes down. That is the only strategy that can save you in this environment. The traditional strategies that you have about, valuations, etc., are becoming less effective because the base itself is changing. What was a 5-10 trillion dollar base is now, more than $30 trillion base. So the base is changing, so you cannot do absolute valuation anymore. The best thing that you can do is you can do relative valuation between stocks of similar type. That is the only thing that can work. So either relative valuation basis, or you follow the principles of momentum investing, and that will keep you out of harm's way. Thank you so much for watching this, and I'll see you in the next one. Bye.